access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, or agents or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit OCC website, www.optionsclearing.com, to read the characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specified or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing the webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Oh, all participants, sorry about that. I got all flustered with all the messed up thing in the beginning. Let's see, assign privileges to attendees and let them talk to everybody, which I cannot believe is not a default. There we go. All right. Yeah, I had a hard time getting in too. Maybe it was everybody. I mean, maybe there's something wrong with Cisco's end. I was blaming poor Greg. We'll find out. All right, let's see what's going on. Oh, wait, participants. Let me see if I can do something here. Am I still in as a participant? Because that would not be good. There I am. Expel. I'm going to expel myself. Isn't that cool that you can do that? Hey, I threw myself out. Uh-oh. All right, now, hopefully that still worked. And now we are going to view, communicate, share my desktop. And hopefully that'll be the end of this part. All right, get my chat window open. Fantastic, okay. This, please. Okay, if you want to chat, please chat in that box that I just wrote this box, please, and that's the only one I can see. Let me move these things to a place where I don't need to look. Okay, and let me get this thing set up. Well, oh, look at that. Oh, wow, that really broke down hard. See that while me and Greg were chatting away? Oh, there's 92 on oil. Fantastic. That's where we wanted to short it. So we'll start by doing some futures trading. We wanted to try shorting oil at 92, and I was just complaining to somebody that I hadn't gotten there yet. So here's 92. Now, 92 is not a good stop. 92.50 is a fantastic short. And as you can see, there's no really resistance between 91.50 and 92.50. Hasn't got any real resistance. But 92.50, I'm willing to take a poke at a short, and if it works out, it works out. If it doesn't, we'll take the loss above the 92 line. And if it does, then we'll take the loss, and we'll hope it goes all the way up here where I can short with a little bit more conviction. Meanwhile, we have good support on the Russell at 115. That could be a potential long spot. The Dow would have to cross. I mean, that's the Nikkei. What am I looking at here? All right, let's get rid of the Nikkei. We don't need them right now. Oh, there's another one. Little 91. Gonna add another one there. There we go. So now we have the 91.96 average entry. Oh, and also when you're doing this, you want to check, if you're working your way into a position like that, you want to see where it peaked out before, and we'll call that like 91.05. So really, that's about where I'd want to stop at if it gets to 92.05. Otherwise, I think I might want to add a couple. So I might want to go to up to 5 at around this spot, and then hopefully cash out. But this is something very important about scaling into the positions. You also want to scale out. So here you go, look at that. So we got this nice sell-off here, and the second this turns around now, right there, boom. You see what happened? Because I bought my first one at like 91.95, then I bought my second one at whatever. I bought my second one around here. It raised my average entry. And then so when I take advantage of a small pushback here, now I'm getting close to my 92 entry that I wanted, even though the stock never actually, even though the contract never actually hit 92. You see that? So without oil hitting 92, by scaling in and scaling out, this is the part everybody seems to forget. I was able to take advantage of the little test of 92, and without actually hitting 92, and I still managed to bring my entry all the way up to 91.98 for the short. All right, so where were we? We're going to look at the Dow. The Dow, okay, so 17,000 should be good support for the Dow in theory. And 1115 is pretty good for the NASDAQ. I'm sorry, for the Russell. I'm losing my mind over these things. And 1980 should be for the S&P. But so here you go. So if 1980 is not holding, I'm kind of disinclined to bet any of them long. So what that means right now, since the Dow is bouncing up from 17 and the Russell is bouncing up from 1115, then this will be the laggard. And so if he goes over 1980, I'm going to want to play it long. All right. Although, obviously, since we know the Russell is bouncier, we might want to play the Russell over Dow because it's going to be more fun than playing the S&P. The S&P is pretty boring. We'll be lucky to get back to 1982.50 here. All right. And if someone could do me a favor and ask a question, just so I know that somebody's there, because right now I'm not actually positive that you guys can all hear me. When you don't chat, I feel like sometimes it's, something went wrong. So if anyone has a question, now would be a great time. All right. So meanwhile, as long as so in other words, I'm tracking several things. See, this isn't working. See, and now if he does go over 1980, then that's strong, and then I'm probably going to want to get out of my oil short. Oh, okay, great. Thanks, guys. All right, so in other words, if this is looking stronger, I want to get out of my oil short. But if the indexes are going down, then I like my oil short. So we'll see what happens. But I'm obviously, at this point, I certainly don't want to take a loss now because it's already had the failure. Once it has a failure and it comes back from that, then I'm disinclined to get out. So I'm going to take this right here. I don't like the way it's behaving. And so we made 30 bucks, big deal. It was up 100 at one point, but you can't cry with spilled milk. It's just we tried to hopefully catch a wave. It didn't work out. All right, so, and I don't like it because he's bouncy and he's bouncy, and I'm thinking he's going to be bouncy, but he can't get back over 1980. So I just wasn't trusting that short. And also because we're in a zone here where you can't really say whether or not it's going up or down. There's no support. See, here's your resistance up here, and here's your other resistance. And this is where we'd like to short it. 92 is where we have to short it if we want to play. Not that we have to short it, but if we want to play, we have to short it. But as I said, you see how he's creeping up? So all these indications, see, and you're watching every tick here. So now it's 12, now it's 16.8. So these guys are getting stronger, and the S&P keeps knocking and knocking and knocking on that 1980 line. So once it pops over, it's probably going to be a good signal for everybody. See, my instinct was right, because that guy's now over 92. So that means I'm kind of liking the long here. So let's take a long on the S&P, even though I said I would rather do one of the others. But we'll take a long on the S&P in anticipation that we're going to go over 1980, and there we are. And so now that we're at 1980, we'll do 2 because the S&P is so boring. The S&P pays $50 per point. All right, so now by adding one after it went up higher, I've now raised to 1979.75. But that means the good side is if I'm right, that's an easy stop out at 1980. If I'm wrong, well, I'm going to be wrong. You know, if I'm wrong, it'll be, we'll probably get out about here and lose some money. Up, so 13, 17 up. He's going up. He's going up. He's stopped at 92. And there's also a relationship there because you have to realize that if oil gets stronger, then there are things like Exxon and Chevron, things like that, and a lot of S&P components that'll respond to a nice rise in oil. And this is a nice rise in oil already. It's up $1 off the floor. I mean, they would have been freaking out if it went lower. So they're all relieved that oil's up $1 today. All right, they have a lot of happy energy companies. Now, struggle over here. He was at 117, he failed. Struggle over here, he's at 13 still, not really making much progress. Struggle here, he got rejected at 1980, touched it for a second, so I'm not too confident here. But like I said, it's worth, since it happens to be, you know, whenever we have a chance to show you the futures at these levels, when, you know, it's so rare that we get such good cross right at the seminar time, it's worth doing. Meanwhile, everybody's red right now. The NASDAQ is red by a teeny tiny bit, and it's trying to get over 4050 at the same time. So we could have a nice cross going on. I'm feeling it, you know. I'm feeling recovery feelings right now. Not big recovery, but I'm feeling like at least a bounce off these terrible levels. And so, and here we go. See, now we're into profits. And meanwhile, that's how fast, well, it was $50 a second. I mean, that's how fast you make $25, $50, whatever. I mean, if you play the futures and you want to make $100 here and $100 there, that's all it takes. You know, you don't have to go for a big kill all the time. All right, so we might have to check our ABX position. Not really. I think it's long term, but we'll look. We'll take a look. How to learn with less leveraged options, minis, contracts. Okay, we can talk about that. We'll talk about that on Apple, for example, and we'll look at those. That's a good question. Target for XRT puts. Didn't we give up on those XRT puts? No, we didn't give up. I'm sorry. We had I'm confused. On Thursday, we still had some XRT puts, didn't we? I'm trying to find the short-term portfolio so I can be right about this. Damn. All right, so let's see. It was Thursday. Here's the income portfolio. There's the short-term portfolio. Oh, we had the September XRT puts. They expired, and they were nicely in the money when they expired because we had left them naked, and that was actually a brilliant decision. XRT, hang on a second, let me get this thing. All right, let's put it in here where oil is because I'm not playing oil. XRT. So that's, now it's 86, so where was it on Friday? Let's take a look. Yeah, so XRT expired at 88.50, so that was, we had the 93 puts. So that was 450 about. So that's very nice. We have a good price there for those. Now, the new XRTs, we have more, but that's a spread. So in the, let's take a look in the short-term portfolio. Where is it? Whoa, are you kidding me? Okay. Oh, nice. Okay, so our short-term portfolio is currently up 48.8%. That's pretty good. That means our long-term portfolio must be doing badly. I don't want to get sidetracked. Okay, so our current XRT spread in the short-term portfolio is the October 93.88 spread. So we're at 86, so this is just on track. So what was the question? What's the target for our XRT puts? Well, we don't have naked XRT puts, not that I remember. Oh, wait, maybe we're doing the 25 KP? You got to specify, guys. I don't like to, I can't hunt for these things. So I imagine it must be in the 25 KP. Oh, yes, it is. Look at that. And these are just the 88 puts. So these were not the same as doing the spread that we did in the other one. So look, we're at 86. We're doing very nicely. And let's take a look at XRT and see what we think it's going to be doing. Okay. This is a nice point to make. Now, watch. So, XRT, we pegged it for doing badly, especially coming into the earnings of retails and so on and so forth. So, we think it's a big problem. So, we picked up we didn't have a huge amount of conviction, so we picked up those 88 puts in the $25,000 portfolio. Now, I'll tell you, I can't believe that they're only 219. That seems ridiculous. If that's what it says, XRT, 88 puts. Yeah, I mean, Terra is a bullshit price. All right, so active trader. Oh, don't forget we have our S&Ps. Please tell me if the S&P starts falling apart. Oh, you see this? Weakness. See, these are getting weaker and these are getting weaker. Ah, there goes my chance to make a profit. Losing faith here, so I think it's time to, let's see. Yeah, it's not working. And when something's not working, get out. Okay, when you get into the futures, you have a premise, you make a trade. My premise was we'd be bouncing, not for any particular market reason. There was no news driving that. I just thought we'd be bouncing off those lines. We're not bouncing off those lines, so I'd rather just get out and be even. I'm happy. I don't need to make the play. It's not necessary. All right, so back to watching oil over here. Could stay with that short, though. All right, anyway, and there's a lot of woulda, shoulda, couldas when you're trading the futures, but it's a matter of, well, right now I don't have time to pay attention. So since I don't have time to pay attention and I'm not sure what it's going to do, then I have to not play. Back to, all right. So XRT, oh yeah, we were talking about it on the chart, and I want to show you something very important. So this is the same, look, the same thing we do in the futures with bounces, the same thing we do with the indexes with bounces, it works for everything. Of course, it's going to stop falling when it hits a 50-day moving average, especially a rising 50-day moving average. A rising 50-day moving average is going to give you better support than a falling one. Like here's a falling 50-day moving average. See how I gave it no support over here? Okay, but a rising 50-day moving average right here, well, it didn't help them much either. It gave them a little bounce over here, and the next day it died. All right, so that's not the best example of rising. Here's a rising one. You see how it gives you support? It fell down, actually hit the 200, then gave you support, but then it failed anyway. So we're looking for one of these doohickeys. We're looking for this breakdown that's going to take us at least to the 200, which is down at 84.50. So if you want to call a target, I think we'll see that. You notice how this thing's kind of tipping over and starting to decline? So, you know, if we break below the 50, that's going to start the 50 turning down a bit. Then the 200 is already not too happy, and this whole thing can start going down. I'm not expecting a huge breakdown. I mean, we'd be thrilled if it gets to 82.50 where there's been support. But 84.50, I think, is a pretty realistic target if I had to pull one out of my butt. But the point is, we had a nice fall here, and now it's going to bounce. Of course it's going to bounce because it's hitting the 50-day moving average. If it doesn't bounce, that means it's extraordinarily weak. But any normal drop is going to pause at least at the 50-day moving average, so you don't freak out and pull your position just because it bounces. But now the question is it going to be a strong bounce or a weak bounce? So now how do we calculate that? Well, that's easy. We've been rejected twice here. And I would call it 89.50. I wouldn't call it 90. We never really got to 90, but see how that big candle there is 89.50? And this one here is like 89.50. So I feel more comfortable calling it 89.50. So 89.50 to 86.50 is $3. All right, so how much of a bounce are we going to expect? Well, let's call it a 50-cent bounce. Obviously, it's 60 cents would be a bounce, 20% of the drop. But let's just be generous and say, let's say a 50-cent bounce is a weak bounce. So that means we certainly expect to see 87 tested on the bounce. And, well, this is kind of hard to do, but you can see right here, it actually is more like exactly, it might be even 60 cents on the button, but between 50 and 60 cents is going to be your weak bounce here. And if it's making a strong bounce, then another 50 or 60 cents, so you're talking about 87.50-ish would be a strong bounce off the 50-day moving average. But if we have a weak bounce intraday and that's rejected, that's a terribly bearish sign. All right, so what's that? No, it's not even there. Oh well. I was trying to be easy, but it's not. XRT. So now look at it in that context, and we'll blow it up a little bit. Oh, wait, no, actually, it doesn't help to look in that context. All right, we'll look in this context. So, you know, so I was saying that it was, I'm calling 89, oh, look at that. See, I eyed that very well on the chart. Now, here it's very obvious that 89.50 is the top, not 90. So 89.50 was the top, clearly. We had a drop back to 86.50. We ignore that silliness, okay? We had dropped to 86.50, so that's $3. That means we expect a weak bounce to, of 20% of the drop is a weak bounce, 40% of the drop is a strong bounce, so 20% of the drop is a 60-cent bounce. Now, here's something interesting. Where's the weak bounce line? 87.10. So if we, strictly 87.10. Now look at how 87.10. This is very important too. You know, as stocks are paying the 5% rule, if on the way down, the weak bounce line acts as support on the drop. So it fell to the weak bounce line, trickled along the weak bounce line, right? 87.10. Then when it failed the weak bounce line, it fell very quickly to its full potential. Now, what's after 87.10? Well, for 87.10, another 60 cents is 87.70. So where's 87.70? Ah, look at that. It's this line. How cute. And look at that. So first it falls to the strong bounce line, bounces off the strong bounce line, fails the strong bounce line, falls to the weak bounce line, then it trickles along the weak bounce line, then it fails, and finally hits its bottom. Now, so in retrospect, you can see how well the 5% rule is working, how perfectly it's following the path that would be anticipated, right? So now we can work our way backwards more intelligently and we say, well, what is this bounce off then? Then now that we know for sure this is a 5% pullback or a 5% rule pullback, we don't know what. Now we say, well, what's pulling back here? And that's kind of tricky because look at how big this run has been and how long it's been. So where do we say that 89.50 was the top? When did it first come there? Here. All right, here's your first rejection. I know it doesn't hit 89.50, but here's your first rejection of that run. Where was the run from? The run was from 79.82, so let's call that 80. So from 80 to 89.50, well, okay, that's 10%, right? That's not hard. So from $80 line to 89.50 is, forget the 50 then, so let's call that the real line. So now we're going to say that 88 is the real top, and the rest is not really something we're going to pay attention to. So 88 is the top. The run was from 80 to 88, and now we look for the retrace. So if we're right, then the retraces of an $8 run are going to be $1.60 and $3.20. So $1.60 from 88 is what? 86.40. All right, so let's see if 86.40 looks significant. Here's 86. I said from 88, right? So 88 is the real top. This is a very different picture then. So 86.40, oh my goodness, that's where we are. Oh, that's so funny. Okay. So now we have a better picture. So what this is right now is a weak retrace of the run from 80 to 88. So the little $1.60 pullback from 88, this is an overshoot. Oh, and by the way, how much is an overshoot? An overshoot is the same 20%, right? So if you're making a 10% run and you make an overshoot, your overshoot usually maxes out at about 12.5%. Well, look at that. That should be 89.60. There's 89.60 right there, this line. All right? That's your 5% rule in action, okay? So then you expect a $1.60 retrace from the real spot, not the overshoot spot, but from 88. So all this is overshoot, this whole few days. So then the real target is 88. And you know what? 88 is the target because, gee, guess what? What puts did we take? We took the 88 puts, didn't we? So we knew this. I forgot, but I knew it at the time. But we said from 93 to 88 was wrong. Everything over 88 I considered overdone. And so when it hit 93, I'm like, ooh, there's a nice $5 drop we can expect. So now it's back to the 88 line. It should go below. I don't think the 88 line should hold. I didn't think it should have gone, it went over 88, but I certainly didn't think the 88 was going to stay. So now we got a 160 pullback here, but it's dribbling along at the spot where it should be dribbling along. But the next breakdown from here is another 140 down from here, and that's going to take you down to 85.10. And what did we say before when I was eyeballing the chart? We said that 85.50. So I guess I do this too much, so I do it in my head. So anyway, so the gist of it is, even when you micromanage the 5% rule, you still come out with kind of the same example, the same spot. So here we feel very, very comfortable then that we should get down to around 85.50, and that's probably going to be where we're going to want to take profits. I mean, obviously we'll watch it, but 85.50 will be pretty keen to say that's a good pullback. We're satisfied with that. All right, next. Should we take profits on XLE? Didn't we do XLE? That was, hang on. Well, we took those off. Yes, we did. We wanted to get 250 for XLE because we were happy with the drop last week. What portfolio was it? Was that the short term? I guess also was we were thinking we had so many shorts in the short-term portfolio we didn't want to overdo it. And it turned out the next day we hit $3, so that worked out very well. Oh, I see. It was $2 at the time last Thursday, and I said let's try to get 250. We didn't get 250 on Thursday, but on Friday it popped up to $3, and so that was the same thing. Obviously, if you're trying to get 250, you get 3. So anyway, XLE should be off. I don't know what they are now, but they should be off. And again, that's because remember we bought another, we re-rolled those DXDs. Yeah, so yeah, we still have those DXDs. We rolled them. That's another question from Craig. We rolled the DXDs down to the 24s and spent another quarter. But a quarter times 200 shares was another $5,000. So that's why I was keen to cash out. We knew we were cashing out the XRT puts, so that was fine. And we additionally cashed out those XLEs because those were another $2,500. So we're kind of like trading in. We traded in the cash, and we put more cash into the DXDs, which weren't working yet, and we took it out of our successful XLEs and XRTs. Not the spread XRT, but the naked XRTs that we were sitting on. Okay, so. Yesterday, the ABX long call was below the price of the spread. The ABX long call was below the price of the spread. Can't you please, guys, tell me what portfolio you're talking about? Oh, Alan Snow's asking, what is the 5% rule? Oh, my God. We have links to that. Hopefully somebody in chat can point you to those. The 5% rule is just to quickly go over it, because I know we have some new people here. So my dad and I used to consult for the banks. Income portfolio, thank you. Okay, so my dad and I used to consult for the banks. We helped design the original trade bots. You know, these high-frequency trading systems they have today, my dad wrote a lot of the original algorithms that made that stuff run. And my dad was a real, he's really, really smart, but he had trouble, like, you know, he wasn't good with the business stuff. So I used to come in there and talk to the bankers themselves. And in designing the program, you had to sort of interface of the computer stuff with all the financial going on. And what I would do is, so my job, his job was to come up with a program that would write. This is going back like 20-something years. I'm not talking about the stuff that's out today, but I'm talking about the original. You know, it got perverted into high-frequency trading. We didn't purposely want this to happen, but what people kept asking for was they wanted something automated that would you know, help them identify trades, make trades, so on and so forth. You know, but they're all based on math. You know, and a lot of my guys say, you know, I have no love for TA, and this is one of the reasons I have no love for TA. I've met all the finest TA people on the planet who work inside the investment banks, and they all are as clueless as anybody else. It's just voodoo. But because TA, the thing about TA is the more people that follow it, the better it works. You know, that's true of anything. If you know, I've on Sundays, if it's a certain something, they move planes to fly over my house, right? So I don't know what the conditions are, but I'm sure it's weather-based, right? So there must be something that happens in the weather that causes them to move the flight path of the airplanes to my house, right? So if I had a little village here and I didn't know anything about the world, and my observation was just based on the fact that, like, sometimes planes fly over my house, maybe I would know that meant a storm is coming. and that I would say, oh my God, you see that big plane flying sky, storm coming, you know, and it could be that's exactly what it is. When a storm is coming from the Newark area, the storm causes them to divert the flight path, and it comes my way. So I know when I see a plane flying over my house, which is unusual, that it means that there's a storm. That doesn't mean that storms are predictive, that, you know, it doesn't mean airplanes are predictive of storms. It means there's a whole causal relationship that you can watch. But it also doesn't mean, though, that I shouldn't bet a storm is coming when I see a plane. That's what TA is. TA is the plane. I'm observing something that's been affected. So it's not that I think TA is meaningless. It's just that I think it's not meaningful enough to sit there and make it your heart and soul of your investing premise. It's just one of the things we look at. All right, so that being said, I am a big fan of 50-day moving averages and 200-day moving averages, and the reason is that is because my observation in working with many of these big investment firms and talking to so many people, and they all want an advantage, obviously, over their competitors, right? So they all bring you into like a secret meeting in a secret room, and they all tell you their things, and here's our strategy, and this is what we want, and this is what we want, and everybody thinks they have their own sauce. You know, it's like having, it's like going to a chili cook-off, right? And everybody's got their own chili recipe, but it's all chili. It's like generally it's chili. And that's the funny thing about it, because they all think they've got something unique, and they all think they're doing something that nobody else does. And I can't tell them because I'm confidential. So I can't tell them. I'm like, yeah, it's the same thing as the Morgan Stanley guy that guy does, except that he has a 0.5% variation on the downtick. I mean, you know, the other guy thinks he's got the Holy Grail that he's sitting on. Then they play, but they all plug in their formulas, and you go to all these meetings with all these people, and they all think they're doing something unique. And the thing is, and this is what I observed that was really key to the 5% rule. The thing is, there's a tendency of people, first of all, to use whole numbers. There's also the fallacy of random numbers. People think computers use random numbers. They don't use random numbers. They use pre-programmed numbers that go in a fairly random sequence, but they're not actually random. Also, there's a tremendous amount of rounding involved. Everybody rounds things off, just like I just did when I said, oh, let's call it 8850 instead of whatever it turned out to be 8860, in fact. It's because there's a tendency of people to round things off in your head. And also the market then, because of traders and investors looking from the outside, they tend to run into whole numbers. No, I did not include the Earth wobble in my model. That was hysterical, though. I thought that video we had today was just fantastic. I mean, that guy is, that man must be voted out of office immediately. Anyway, it's the stupidest thing I ever heard. So from a trading perspective, though, it's the same thing. It's everybody believes this and believes that, but in the end, they all, because they talk to a guy like me, and I'll talk to a programmer, and the programmer will then interpret inside the code, and I know this really well because I was at the time a bad programmer, so my father was trying to teach me. It was kind of hopeless, but on the whole. So I knew enough programming to be very, very dangerous. so from talking to my dad and understanding, and he was always trying to explain to me what he was doing and why he was doing it. And the reality is, the programmers round things off and average things out when they're writing the code. And the people giving the instructions round it off. And then you talk to the guy, you talk to the floor traders, and they want one thing, and then the other guy wants another thing. But then when you go upstairs and sit down with the executives, they start rounding it off too. So in other words, what you have is you have a whole bunch of investment houses running a whole bunch of programs that are all rounding off here and rounding off there and rounding off there. And what's the magic number? 5%. And it's not so the 5% rule is based on the tendency of large systems, large trading systems, and large groups of traders to end up making incremental 5% moves on the things that they're trading. So from observing that, now, when I say 5%, though, by the way, it's a 5% rule because of the major movements of the indexes. The major movements of the indexes tend to go in 5% increments before they retrace or stop or pause. So because something that liquid, you'll get it. Whenever you have a very liquid stock or an ETF like XRP, you'll get that kind of movement too, very predictable. So 5% significant, 10% very significant. It skips to 20%, then it goes to 40%. So it's like that, and that also has something to do with Fibonacci numbers. There's also a natural sequence called Fibonacci that also follows something similar path. But because of the rounding that people tend to do, stocks tend to be more accurate to the 5% than they go to the Fibonacci sequences. But then if you lay the Fibonacci sequences on the stocks, they look very accurate because they're running the 5% rule. Essentially, Fibonacci came up with the 5% rule before I did. So back to this. So below 5%, though, this is very tricky. This is what people don't fail to get. Below 5%, though, there's a 2.5% rule, there's a 1.25% rule, and a 0.6, whatever the hell it works out to. whatever half of 1.25% is, 6.25. Yeah, 0.625. So it goes down to that level, and that matters on the Dow. You know, if you're watching a very big index that makes very big moves, it matters. That 0.625% matters. All right, not obviously we don't use it much right now, off the top of my head, 0.625, but 1.25%, when you're watching an index, those are big moves. So the key is from that, all of those things get retraces. So in other words, when the Dow moves up 0.625%, which is God knows what, but let me see, my handy dandy calculator here. So you got the Dow at 17.1, right? So 17,100 times 0.0625, and that's what? What did I do? Oh, 17.1 times 0.00625. There we go. So 106 points. So when the Dow makes 106, 107 point move, then you're into a territory where it's going to retrace. And what's it going to retrace? 20% of that move. All right, so likely when you see the Dow moving 100 points, it's going to pause there and pull back. And your pullback is going to be around 20 points. That's a weak retrace, and a strong retrace is a 40-point pullback. All right, so that's what you observe when you're watching the Dow. And let's take a look at the Dow. We'll see what we see. Although these are daily, so it's not really gonna DJ. What a tangent we got off on here. All right. So you're not going to, well, what you see here is you can see the bars there, right? You see this is like a 100-point bar. You see how that works? That's the bar you expect on the 5%. You'll see the 100-point bar going up, the 100-point bar going down. Just like that. Here's another 100-point bar. So at this level, these are the 5% rule bars you're going to expect. When you see those, you can assume that there's a lot of computer trading going on. 100-point bar, 100-point bar, 100-point bar, 100-point bar, 100, you know, it's all over the place. So, you know, these are expected trades because this is what the computers are doing. So if you flip the bull button on the computer, and I'm really obviously super simplifying this, but there's essentially a bull and bear switch. I mean, that's what happens. And the big guys, even after you write this program and even if you put in all this predictive modeling and all this stuff, it still comes down to one of the executives saying, make it bearish, you know, and they flip the bear switch. You know, and there's a percentage. So you say 10% more bearish, 20% more bearish, 30% more bearish. They make it more bearish. They've got a little dial, and they turn the dial, and they change it this way and that way, and that adjusts the model, and everything flows through. But you know what they never say? They never say make it 12.5% more bearish. Nobody sends a memo. You know why? Because you feel like an idiot. You write a memo, and you say, let's get 14% more bearish today. You know, nobody does that. They'll say 15% or they'll say 10%. They won't say 12.5%, hardly ever. And nobody says 13 or 14. You know, because you seem like a moron. You say, oh, yeah, like you know exactly 13%. You know, people are going to make fun of you. Even if you avoid blank buying, somebody's going to make a joke. You know, your buddy is going to say, hey, what do you mean 13%? What do you know? You know, so you tend not to do it just because it seems silly to be that exact. Human tendency is to round things off to whole numbers. And that's what happens. So that's what Blake Fine's doing. That's what Jamie Dimon's doing. That's what every single hedge fund manager and every single trader and every single investment house, they're all doing that. They all sit down, they have a meeting, they have discussions, they decide what they're going to do, and they always come up with some whole number. And when everybody's coming up with whole numbers, then everything ends up moving in 5% increments. That's just the way it works. All right, so that's what the 5% rule is. And then how do you use it? Well, you expect things to move in 5% increments. So, you know, on an index, you'd look for 1.2, you know, 0.6, so you look for a 100-point move. Then after a 100-point move, you're going to be looking for a 1.25% move, which I guess is about, well, obviously it's going to be, if 0.62 is that, so 1.25 is going to be 112 or 115 points. That's a 1.25% move. And then 230 points is a 2.5% move. That's going to be a very significant move. And 2.5% on an index, you're not going to expect to see a 230-point move very often. And what do we have here? See this? 200 points right there. That's basically 200 points there. Here's something like 200. This drop from 160 to 0, that's a 1.25% move. You have 1.25% drop, 2.5% rise, 1.25% drop. So far, we're probably going to finish that and go back down here to the 2.5%. And what's this? Oh my God, it's a 5% line. It's 300 points further down. It's another 2.5%. Isn't that amazing? And it's not amazing at all. That's what the rule is. All right, so we can chart these things, and we do chart these things. These are the big chart numbers. We chart these things months, years in advance. That's all we have to do. All right, now this works best with larger indexes. It doesn't work as well with smaller indexes, and it also doesn't tell you which way things are going to go, except for the bounces. It's pretty good at that. It doesn't necessarily tell you which way things are going to go, but it tells you when something's gone too far or is too low, and it tells you where you can expect the bounce to go, and if you get a bad signal off the bounce, it helps you decide that. But it doesn't, it's not TA. And frankly, I never used to chart this. I used to talk about the 5% rule back in 2006 and so when I first started teaching this to people. And until a couple of years ago, we never really charted. I think in 2011 we started charting it because Jean-Luc started doing it for us, which is really great. But I don't want people to get the misinterpretation that this is not about TA. It has nothing to do with TA. This is math. So, I mean, you know, until Jean-Luc started charting it, the 5% rule was just that little box chart. That was what the 5% rule was. And yeah, it's very helpful to have a visual, but it's not like TA, because people used to TA and you think these bounce lines do something. They're not meant to do something. They're just meant to show you the ranges. And if you know your ranges and you understand your ranges, you can do some fantastic trading. All right, so let's see. I want to get back to that other question. ADX long, well below something in the income portfolio. Okay, let's take a look at the income portfolio. Got to be our worst performing portfolio at the moment. Let's see. Oh yeah, Apple spike. I wonder how that's going to be. Oof. The reason this is killing us is because this Apple short calls are killing us. You know, in here. So that's always, it's going to look very, very ugly until that thing resolves itself. It's not off track, but the net returns are going to look bad. That's the problem with it. All right, so you're talking about ABX, and of course we have trade like ABX if it's in there. There it is, ABX. All right. So what is the ABX play? We have 10. We're going to buy 1,000 ABXs. That's what we're promising for net of 17, and it's at 15.51. Not good. On the whole, though, the trade isn't down much. We got minus 27 here, and plus 3 and minus 350 here. So call it minus 3, and then 16 is so roughly $1,400. This trade is down. So it's down $1.40 per long. Our target price is 17, and ADX is a 15.50, and it's right about $1.40. It's $1.50, so that's fine. So our entry is 17. We're down at 15.50, but of course there's still plenty of premium left in these guys. We did sell the 22 calls, and I would like to make an adjustment. So the question is, on ABX, do they have 2017s yet? And I don't think they do. Otherwise, I would have called for an adjustment already. ABX, because we just looked over the portfolios on last week. Yeah, oh, there they are. Wow. Oh, maybe they didn't. I don't know if they had them or they didn't have them. Now I got to find out. Hang on a second, let me check that screen. Let's see. Here's my comment from last Thursday. Beaten up with gold, no change in the long-term outlook, not worth rolling as the 2017 $17 puts at only $3.35. Ah, is that still true? No, now they're moving up a little, $3.65. So our puts look like a good deal. Oh, that's why. Yeah, look at that. So in other words, our puts are $3, and these are $3.65. So all we would make from this roll is 65 cents. That's silly. All right? If I was worried that ABX wouldn't come back, then this would be the intelligent roll. We could roll to the 15s, So we drop our price by $2, and these are $2.40, so it would cost us, what, like 60 cents to make that roll. So I'd rather pay 60 cents and roll $2 lower. That way you're buying $2 for 60 cents. You always want to buy $2 for 60 cents, right? So if we were worried about ADX, I'd do that, but I'm not in the least bit worried about ADX. I think it's going to come back. Let's see what other intelligent things I said last Thursday. In fact, since the April 17 puts are $1.98 with $1 premium with 2 days to go, I think the spread of buying the underpriced, oh, I see. So I said since the April 17 puts were $1.98, wow, that is a lot of money. April 17, oh, look at them now, they're $2.25. Okay, cool. So those are $2.25. I said the spread of buying those, I'm sorry, the spread of buying the underpriced, oh, I see. So my plan was to buy this 2017-17 puts. They were $3.35 at the time, so now they're up 30 cents, and sell, this was just a conception as a new play, and sell these guys for $2, for $1.98. And you know what? We'd be up a dime so far on the spread, because those guys, the long ones gained 35 cents, these guys gained 25 cents. So that spread would be up 10 cents. Not exciting, but really the net cost of the spread, you're actually up about 10% already. So do you understand what I'm saying? You know, when you don't like the price of something, so in other words, these were too cheap, and I wouldn't roll to them because they weren't worth it. I wasn't getting paid enough to make that roll. But then I'm saying, well, since I think these are too cheap, how could I figure out a way to make money off that fact? Well, if I buy these 17 puts, which I think are too cheap, and I sell the April, was it April? Yeah, and I sell the April 17 puts because I think they're too expensive, then my net cost entry on that was going to be what? Net 65 cents. And then when these expire worthless or whatever, hopefully these will expire worthless and these would still be worth like $1, and I would make 35 cents. And already it's up a dime. Do you understand that logic? So, you know, if you don't like the price of an option, if you look at the option price and say that's ridiculous, that happens sometimes. People ask me a question, I look at the option price, and I'm like, oh, that option's ridiculous. And it's like, well, great. If it's ridiculous, there must be a way to make money on it then. Either if it's too high or too low, you got to start your brain working and say, well, how can I profit from the fact that this option is mispriced? You know, it's like if you're into real estate and you find a mispriced house, right? It can be too high, it can be too low. When you find a house that's too low, you buy it, right? So when we find an option that's too low, we try to buy it. We find an option that's too high, we try to sell it. All right, so let's see. Back to the wobbles. All right. I wonder whether you can have some time talking about ABX GLL trade later. Okay. Well, I think we had a trade where we talked about getting a GLL bull call spread because we thought that gold bottomed out here, and then selling ABX as an offset. I don't think that's an official trade, but conceptually it's the same thing. I certainly don't see ABX going below 15, or not. I'm sorry, it could always go below 15, but I don't think it'll stay below 15. So you could sell these. Well, once again, this is a crappy price. But you could sell the these ones I would sell for $1.80, the 15 puts of January 16, and that gives you $1.80 to spend. I mean, and again, you have to assume you really, really want to own ABX for it, you know, at net 15. So if you really want to buy them for net 15, they're at 15 now, then this is giving you free money, right? Because your worst case scenario is you buy ABX for 15. So then you take your free $1.80. You move over to GLL, and now we find a spread on GLL. So we go back ourselves all the way out to here. This is as far as they go with April 15. I got $1.80 to spend. I think 95 is a good bottom. But let's call it, oh, here you go. See, these are, this one. Didn't want that to happen. No, not those, the 90s. All right, let's say the 90s. It's hard to tell with these spreads because they're so crazy. Oh, and by the way, one of the tricks I do is if you can't tell what something's going to be priced, you try to find a narrower spread, because the more narrow a spread is, the better chance you have of filling it. In this case, though, see how these are 9.40.10, and these are 9.90, 10.50, and then these are 10.40, so they're going up about 50 cents each. So realistically, call this 10.25. That means I'd pay 10.75 maybe for those at most. 10.25, and then these would be 10, no, I wouldn't pay 10 for those, see? So I'm going to start with a lower base. Here's how I come up with the logic. So between 940 and 10 is 960. That means I would pay no more than 1010 for these. And that means I would pay 1050 for these. So I would offer, oh, I'm sorry, from 1050 here it's 11. So I would pay 11. So I'd offer 11 for these and see if they fill. And then you've got a free $1.80. So let's spend $3, let's say. So I'd want to get 7 for these, the hundreds. And so I would want to get the 9100 bull call spread for $3. So $3 less the $1.80 we sold those puts for is 120. And so you're into the 9100 bull call spread for $1.20. And where are we now? We're at 96. So that would be an excellent spread. You understand? So you're $6 in the money on that spread. The spread only costs $3, and you're going to subtract the $1.80 from the short puts you sold. That's a nice way to construct a trade, right? So all gold has to do is not go down. Oh, wait, that's ultra short. Oh, my God, that would be bad. I'm sorry. Ignore everything I just said there. That would be extremely bad. This is the ultra short gold fund. I don't want gold to go down. I want it the other way. So you confuse me. Now, you very much confused me by saying GLL. I was thinking GLD. I'm long on gold. I don't want gold to go down. So that would be the opposite. GLD. Let's try that one. Ah, much better prices. See, these are a lot better traded. All right, so with GLDs at 117, so it's the same logic though. Let's say 115s happen to be $10 also. And now we said we want to go about $3 higher. So let's say this one, the 122s. All right, so we could do the 115, 122 spread for that's gonna be like 680 and 1015. So it's about 325. So it's about 3 1/4 here, and then you subtract the 180, and you're in it for like for about $1.40 or so. All right, so say it's about, so you're going to net out, with the sold ABXs, you're going to net out into the spread for about $1.50 or so, $1.60, and you got a $7 spread. That's $2.66 in the money, and you're bullish on gold from this price, which is what? Gold is now $12.24. All right, so that's how we construct that trade. Can you speak to this? Those of us holding positions in all these different stocks. Facing the falling market is patience. What do you preach since they don't expire until 16? Are there any adjustments or whatever you suggest? Okay. Well, Craig, first of all, I like all those stocks. That's number one. Number two, hopefully hopefully you're scaling into these things. Hopefully you're not fully committed to all these positions. Because if you're fully committed, it's a problem. You really got to lighten up because you never know. There's nothing stopping this market from completely collapsing. In fact, as we speak, this is why I can't play these futures while I'm talking to you guys, because it's too, I can't do it if I'm going to flip around anyway. Oh, no, that's not it. Active trader. As we speak, they're breaking down further. See? Everybody's breaking down. Oh, that's XRT. We don't care about that. Well, we do care about that. There's XRT breaking down. TL. See? Darn it. Anyway, that's short, right? So where were we? All right. So there's nothing to stop prices from going 50% down. Nothing. You always have to assume that could happen to your positions in a crash. Doesn't happen often, but it does happen. So if the whole market crashes and all these positions go down 50%, if it represents 1/4 invested, if you're in, if you're scaling in, and this is in our strategy section, which you guys all have to read, it's very, very important. If you're scaling in and you have quarter-sized positions on all these things, then you want the market to crash 50% because you're dying to double down at an incredibly cheap price. All right? But if you're heavily invested in these things and they're falling below the prices you expected and you can't take the losses, get out. Patience is what you do when you have a plan. Patience is not what you do when your plan is to cross your fingers and pray that your portfolio comes back. All right? We've been going through this year with minimal investments in our portfolios. Which one is this? The income portfolio, look at the margin requirement. This is a $500,000 portfolio with $1 million of buying power, and we're using $117,000 of it. That is 10% invested. We're waiting for a nice crash so we can start buying stuff. We want these things to drop like rocks. That's our plan in this portfolio. We want a low price. In the long-term portfolio, we're much more aggressive. In the long-term portfolio, out of $1 million, we're using $300,000 worth of our buying power. 1/3. We're using 1/3 of our buying power. All right? So the idea in our long-term positions is that we're making very, very small investments. None of these things are going to kill us. And like Hub here, which is down, right? We'd love to buy more of that. I'd love to have 10,000 shares of Hub at less than $5, or $4, or $3. I would love that. Do I not want to own 30,000? Do I not want to own 10,000 shares of Hub for $30,000? Are you kidding? When I bought it, it was, you know, I don't know if it was 5 when we bought it, but whatever. But our net on this entry here was 4, right? So if it goes to 3, I want more. I don't want less. I'll take 350. That's good. I'll buy more. This is only 4,000 anyway. So right now it's at 350. It's not low enough for me to double down. I bought it. You know, we bought it for 405. So we bought it for 405. Now it's 383. I know that the puts are down 100%, but I don't care about the puts. I'm trying to buy Hub Canadian cheaply. My goal when we started was selling the $5 puts for 95 cents to give me a 405 entry. Mission is being accomplished. I'm going to get my 405 entry. If I get a cheaper entry, I still want it. That goes for the other guys. Yeah, it goes for Cliffs. That goes for Transocean. That goes for BTU. It goes for General, whatever the hell they're called. It goes for iRobot. For GT Advanced, that's what it's called. And it goes for iRobot. It's the idea is that I want to buy these things when they're much cheaper. You know, when I'm looking at a chart, IRBT. So when I'm looking at iRobot, I don't look at this chart. This is a short-term chart. I'm looking at the weekly chart, and I'm saying, man, I hope I can get in here. Because if I had gone in here then, that would have been a gold mine. So when it comes down towards 25, I'm backing up the truck. If it comes down to 25, if it doesn't, I'm going to have to be satisfied with whatever position I end up having. Which here with iRobot, let's see what we did with iRobot. Here we sold the $30 puts. So what am I saying? I'm saying I'll buy 1,000 shares for $30. Yeah, absolutely I will. Then we bought. Then since I'm happy to buy 1,000 shares for $30, this $3,000 is free money, right? Then we take the bull call spread, which is less than $3,000. So I still have a $600, $700 credit here. And all I'm doing is promising to buy iRobot for 30. How much is iRobot now? 31. I'm still waiting for my price. If I don't get my price and iRobot goes higher, I keep the money as a consolation prize. But I really would like to own iRobot cheaply. So, you know, you have to define what you're saying when you talk about patience and this and that. I care less right now about what these prices are doing. My plan is to buy this stuff. My plan is to move these positions to these positions, to ownership, where I own the stock and collect, if they're dividend payers, collect the dividends. If they're not dividend payers, you only have 2 dividend payers here, but if they're not dividend payers, then I'm going to sell calls against my low price positions. And then my conversation will be the opposite with you, because then we'll say, oh, well, we got into iRobot for 25 and we sold the $30 calls, and now it's at 35 and we're going to get called away. And you'll be panicking about that. And then I'm going to say, well, you know what? We're happy to be called away. We bought it for 25 and we get called away at 35. It's okay. That's why, you know, the point is you want to take the money off the table when it's going up. When it goes down, I'm not taking my money off the table. When it goes down, unless I don't like the stock anymore, that's when I'm buying. That's called buying low, selling high. And I know it's hard for everybody, but that's really how the market works. But that does take patience. It takes patience, it takes conviction, and it takes also a a strategy of portioning your portfolio and managing your portfolio so you don't overexpose yourself. And I know it's hard because especially the hardest thing about the system that we're teaching here is that you start off very small. It's very frustrating to only, and only is a weird word, but here's the long-term portfolio, right? We're up 20%, but we only use $300,000 to make $100,000. I mean, wait, what are we up here? Yeah, we're up $100,000. So we use $300 to make $100. So, you know, we had $1 million of buying power. So, of course, you're going to say, well, geez, if only I used a whole $1 million worth of buying power, we'd be up $300,000. But that's not, but you can't do that because, God forbid, it goes the other way and you lose. Because if we had lost $100,000 off our $500,000, that would be bad. That would suck. But we would lose that because the market went more than 20% down on us. And that means that with the $400,000 we have left, we could still buy what used to be $500,000 worth of stocks. You understand that? Because if the market, let's say there are any random $500,000 worth of stocks, the market drops 20%, they go to $400,000, right? So if we still have $400,000 of buying power, it means that we can still buy the same amount of stocks in quantity that we could have bought when we had $500,000. So we're not really in bad shape. We just happen to hit a market low. All right, so then we pair that with the fact that we enter our positions with a hedge and so on and so forth, and we have the hedge in the short-term portfolio, which is up like almost $50,000 bucks. So there's another $50,000 we get to throw onto the fire while the market's going down, and we end up in pretty good shape on a downturn. It's all about balancing your portfolio and portioning your portfolio. That's what's really important. All right, so where are we? So we retested the lows, and they seem to be holding. Hedges are helping alleviate the pain, but still wondering if these just require patience. Well, we have different kinds of hedges. Again, I just said last week, Friday, Thursday, the short-term portfolio was down to just 30%. I mean, down to. I mean, it was up just 30%. In fact, it was 30%, 30.00 at 321 on Thursday. And what did I say? I regretted not taking them off the table when they were up 50%. We should have just cashed the frickin' thing out and gone the other way. And here we are up 50% again, and I have to really think about that and say, gosh, shouldn't we be cashing this thing out? We can't cash it out, though, until we decide what we're going to do about the long-term portfolio. Because I cashed the short-term portfolio, I'm leaving us totally exposed on the long-term portfolio, right? But here we are. We could take $150,000 off the table completely, cash out the long-term portfolio, take $600,000 off the table, and that's $750,000 from a $600,000 start. We should just take that and go to Vegas. There's no reason to keep playing. It's up 20% for the year. We could restart the whole thing from scratch and start picking other things. But now we've got $750,000, so now we can start buying. In fact, you know what? I'd start buying the exact things we were just talking about. I would start building a portfolio with these stocks, the CLF, RIG, BTU, GTAT. You know, that would be my start of a new portfolio, because those are the most beaten down stocks. Those are the ones I'd want to reset and get on. So when we're talking about it now, though, would I take it out of the static portfolio as it is now? No, of course not. Because those are the ones I'd buy first if we start buying things again. I want to buy the ones that are beaten down. I don't want to buy the ones that are up. So I'm really torn on that because it's so tempting to just cash out right now. It really is. I mean, you know, we're not going to be down. I mean, obviously, what you can do here is take this $50,000 gain off the table, and then look at your long-term portfolio, which is up $100,000, and say, okay, if it falls where it's up $75,000, then I'm going to quit. But as long as it stays over 575 total, then we can leave it on. You can always just do that, and that simplifies your life tremendously. Because as we've seen from observation, it really doesn't lose more than about 5,000, 10,000 in a really bad day. So there'd have to be a pretty severe downtrend to want to get out of, you know, to kill the long-term portfolio, make you stop out. In the meanwhile, though, if you take $150,000 off now and you have 575 in the other one, that's 725. So you're still up 20% for the year. You're still at goal. So you could cash out the long-term portfolio, have a $25,000 hedge in the long-term portfolio left of cash, and you're locking in a 20% gain for the year, no matter how badly the market does. I mean, I'm sorry, unless it drops 10% in one morning, like unexpectedly. But either way, you'll be damn happy to have the cash if that's the case. You'll be really glad you have your cash. So I hate not cashing out. I wish it was easier, but it's not, because we'd have to unwind all these trades. And so this is what everybody goes through, though, in the portfolio. It's just the whole idea of unwinding and putting them back on and doing this and this. And it's not like I don't like the stocks. So that's distasteful. I don't want to do it. And also, by the way, we did cash out the income portfolio earlier in the year and left the long-term portfolio open, and it turned out the long-term portfolio did much better because we left it alone. So that was a lesson for us also. All right, so should have kept your oil short through the webinar. Yeah, like I said, it's all woulda, shoulda, coulda with these things. I couldn't watch it, so that was the end of it. Where are we now? Boom, boom, boom. Okay, see that support line? That's good. The Dow, if it gets back over 17, this is a good long, especially if you poke over 115. These guys held 1975. See, that line's been holding up very well across here. So those are good signs. Oil's bouncing off of 91.50. All right, so we do have some nice bouncies. I'd be looking to go long on this guy. Let's do that and see what happens. Look how fast it moves. Whoa. Oh, thank you. Okay. So we're at 16 now. So you went long here, but what line are we watching? Oh, you gonna give me a cheaper one? Come on, I dare you. Give me a cheaper one. Ooh, you thought of that, didn't you? Now he's running away. Okay. So basically, once 17,000 gets taken here, I would set my stop here if this guy fails 17 again. As long as he's over 17, I'm going to be pretty comfortable with this guy. And, of course, I'll be watching this one, too. So I don't want to see him go below 1975 for sure. Well, actually, I'm sorry, 1977.50 I would draw the line. So here I'm going to watch 1977.50. Here I'm going to watch 17. And here I'm going to be long. Oh, damn it. You really don't have time to talk when you're doing these things, I got to tell you. I would have just hit the trigger right there on another one. I'd like to I see if I can get now. I'm doing the math. If I'm at 1143 here, I want to be right here with another buy. So why don't I put that in and watch him flush it? See that? That play was nowhere near where these things showed me at the time. But I put my bid in. All these are fake. That's why most of the things you see in the futures are fake. They're fake orders. They're robots trading with themselves. And when they see something and they want to flush it, they bop down and grab it. That's not a good sign, though. I'm not happy about that, because that means they really wanted to take my buy. And if they want to take my buy, it means it's probably going lower. Oh, and you see that? Failing and failing. So not good. So I'm going to get back to 1. Oh, here we go. See if we can get rid of that. Probably not, though. Nah, see, they don't want that one. They wanted my buy. They want me to buy it, but they don't want me to sell it. That's another way you can tell direction. You know, in other words, when you put it in, if your order gets filled fast, it's probably wrong. The faster your order gets filled, the worse it probably is. So, but we're watching this line. I want to see what happens here. Remember 1977.50? Blown. Okay, and 17,000 blue. So we're actually going the wrong way. So I'm going to kill that. And my decision is, can't go long on oil. He's not looking good either. Oh, come on, baby, don't die on me. Now I got 2, so now it's 20 bucks. Every one of these ticks is 20 bucks. See, this is, now we're back at the previous low, and now it's getting a lower low, and this guy is not doing well at all, and that means I should be glad to only lose 160 bucks here. Let's see what happens. Oh, as I said, I should be glad to lose 160, now it's 200. But let's see, 13, all right. 112.80. Damn. There you go. That's testing a low over here. So I'm going to buy one more. just out of principle. And now we're 113.63. So that means I know I want to sell one here. Up right away. So as soon as I get a chance, I'm going to sell it. There it goes. See that? Notice I made my offer 2 ticks above where it actually was, and still filled. Okay, because these orders, even in the middle of a trading day, most of these orders are fake. It's sad, but it's true. Now, get out of another one. There we go. And now, let's see there. I've accomplished what I wanted to do. My basis is now below 113. All right, so now I can hold on and see if it gets a little move up. I'm not as worried as I was before. And that's how you make it in. That's called laddering into your trade. So you have to do that. You can do that, by the way, with option contracts. You can put up an option contract in this box and do the exact same thing. So if you want to work your way in and out of spreads, that's how you can do it. Oh, look at that. Yay. So somebody today, Advil was saying today, it's like, how come you don't call out these things exactly on the futures? Like, how am I going to call that out? How am I going to sit there and type that out while I'm doing it? I don't have time to make the trade, let alone type it out. You have to just learn how to do it. You know, that's the point. You got to learn how to do these things. You can't to say I'm going long, I'm going short, I'm getting in and out. No, it's just you got to say generally, I think this will hold. It's bouncing, and then people have to know how to play it. Unfortunately, that's the best way to do it. There's no magic formula there. All right, so we'll see how things are shaping up. He's way down, but now see, even though he's way down below where I wanted, he still hit a bounce line. So that should be some support. This is really technical support, but it should be some support. Even technical support gets support. 1975 should be support. So I'm in not a terrible position there, but again, so we're going to move on. So it's time to kill this trade. Because I want to get back to it, finish. We're going to go about 15 more minutes, so I want to finish that up. So where were we? The GLL was a bear put. Yeah, GLL bear put's the same thing as a GLD long, actually. They're both usable. So it's the same logic. Let's see. You have the original GLL 91.86 put spread. Let's see. GLL. Is that January? I don't know what that is. Is it April? It's January. It's probably January. So if you have the 91 puts, those things are $4, right? I have to make assumptions because nobody's there. You guys got to be clear about what you're saying. Otherwise, I got to make assumptions. Okay, so let's see where we are. So you have the 91. Let's say you have the 91.86 spread here. Well, first of all, we're at 96, so obviously it's not working out that well. So you want to salvage the money you have here, which is $4, and roll it to something that you want over here. So I would go to like 92s over here in April at $6. All right, with 92. 92 is like 680 or whatever it's going to be. All right, so I would spend the 280 to go there. You're going to wait for these puts to expire, and then when they expire, you'll be able to sell something else, or at least $2 to pay for the cost of your roll, and then you're into a better roll with a longer amount of time. All right, that's how we adjust those. So you got to get out of these spreads before the price of your long goes below the price of the spread. Whatever so whatever your net for the spread is when you went into it, if you paid $250, you got to make a roll before it goes to $250. Before your long position goes to $250. So in this case, you're long the 91 puts. You got to salvage that money before it disappears. All right, so we recommended GLL for decay, but now it's September, so there's not much time for decay if you have the January. If you have the April, it's okay. I would just leave it. But if you have the January, then now you don't have as much time for decay, so you've got to take some kind of action to fix it. Craig says, how do you know when they are cheap enough? Well, I assume you mean just options in general, or I don't know, or stocks. Well, they're cheap enough when you calculate out the enterprise value of the company, look at its debt situation, look at its cash situation, and you figure out a fair, bottom line fair market value. At what point is it? You got to look at all the competition. You got to see what everybody else is getting. You look for the lowest priced guy on a PE basis in the sector, and you look at what their financials look like, and you compare it to your guy. and you've got to understand whether they got a lot of debt, whether they got a lot of loans, how they're performing, look at their cash flow. But when you get all that, you come up with a number, you say, okay, this is as low as I think this will go. Let's see. April. Francisco, April, I assume that's your GLLs, right? So if your GL is April, there's nothing to do. Yeah, we just that we are playing for the decay. We assume there's going to be a certain amount of decay day by day. So hang on, though. I'm sorry. Wait, you have the April 91.86s, though. So you got the 91s. They're $6. No, you have the ones I was just saying to roll to. That's funny. So you have the 91s. They're like 620, 630, whatever the hell they are. Now, for if you can roll, I would offer to roll to 94s for $1.50. So in other words, if you can roll $3 up for $1.50, I would do that because obviously you're buying $3 for $1.50 in position. So if you can do that, I would. I don't know that you can. It looks like you can, though. In fact, it looks like the 96s are $9, and if yours is $6 on the what? On the 91s, no, that's $5. I would do it if you can get it. You know, if you can do it for half price, if you can spend $250 to roll the 96s, whatever the roll is, if you can do it for half the price of the position that you're gaining, then it's a good deal. All right, you can wait for decay, but decay isn't a magical thing. You also have to hope gold prices come back by April. If not, though, it's the same thing we were just saying. You want to salvage whatever the net you have. So in other words, right now your net on a 91.86 is what, like $2 or $2.50 maybe. So let's say it's like, all right, let's split the difference. Call it $2.25. Your net now is $2.25. The 91s are $6, so they're way, way higher than the net of the spread. I don't know what you spent. You certainly didn't spend $6. But in other words, what's key there is if you spent $3 on the spread and you were hoping to get $5 back, then right now it's a 2. It's not tragic, but it's not great, and also you're out of position. So you might want to consider moving to a higher spread in total, or you might want to consider just rolling up, but taking advantage of the dip in gold if you have faith, and like I said, spend half price to roll. So whatever you feel comfortable rolling to, if you can do it for 1/2 the amount of the strikes that you're rolling, then it's a good roll. And Tal says, I was contemplating when to roll. I don't know what that means. Sorry, I lost track of that thread. But, all right, so you were contemplating when to roll. So where were we? Boom, 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 charts. Feel free to, elaborate if you have something, but I'm just trying to figure it out. Oh, you son of a bitch. Now it's up to 115. All right, whatever. Whatever. Oh, okay. Here you go. So, we're bouncing off these little lines. These are terrible bounces. Every time we're having a weak bounce fail, weak bounce fail, weak bounce fail, all the way down. It's like a ball bouncing downstairs, okay? Do you get excited when it bounces? And again, this is what that weak bounce, going back to the 5% rule, this is what these weak bounces are. It's like physics, okay? It's like a ball bouncing downstairs. When a ball goes down the stairs and bounces, it does hit the step and bounce. But you know that it's going to bounce lower next time. But every time it bounces high, see, this is the problem. You guys are so, and this is on purpose though, you get so conditioned to buy the dips because there's been like 3 straight years of rewarding people who bought the dips. So people just think buying dips is the way the market works. And that's what makes these little bounces, because every time something goes lower, people go, oh, I got to buy more. And that goes for the demon stocks we were just talking about, for CLF, for BTU, whatever. We're not buying dips. We're not rushing in. It's not our job to save them. When they're saved, we'll take another look. When they're saved, we'll decide whether we want to allocate more into our portfolio. And saved sure as hell doesn't mean one day. We're talking about multi-week moves. So when I say something is saved, if I'm looking at CLF, all right? There's no saving here. This isn't a save. That's not a save. That's not a save. That's not a save. That's not a save. See, you guys, if you run over the time, everybody starts calling me again. All right. What I want to see here is some real consolidation, something like that, like a little W formation, something like that. See, if this guy starts forming a W, and we go up and we break that 50-day moving average, that 50-day moving average is going to be down around 16 by the time he gets up there. I'm sorry, not 50, that's the 200-day moving average. So since these are weeks, okay, that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All right, so we're talking about like 3 more months before this thing is likely to challenge the 200-day moving average. 3 months. And maybe it'll be at like 16, 17, right? That's when we might want to start adding more. And again, the fact that woulda, shoulda, coulda. Maybe we, you know, obviously you're going to say, oh, damn, I wish we had added something here. But that's not how it works. I'm sorry, hang on, it's got to be my daughter or something. Hello? Hi? Okay, but I'm doing the webinar right now. Call me back, I'm doing the webinar. Yep, daughter after school. Okay. Sorry about that. All right, where were we? Oh, yeah. So we want to see a real bottom form. So if we had a double bottom here and we're back over 15, I might get kind of inclined to do some more with it. But other than that, I'll let it play out because, frankly, well, where are we on Cliff? Can somebody tell me what the position is without looking? Let's see. CLF, where is that? Long-term portfolio? Yeah, okay. Oh, in fact, we got more. What did we do here? Okay, yeah. So for CLF, we have the 1018, and we sold the 15 puts, right? So what would we like to do with the 1018? Well, 10 is fine. 18 is fine. I'm good with that. What we might want to do is maybe buy these guys back, and then we don't have to worry about we have these naked. But notice that the spread here, 485 minus 175 is what? Is 310. So we paid 310 for the spread. I'm not worried about this spread until this guy goes to 310. So I still have 310 of value I can pull out of this trade. All right? So at 310 is when I start worrying about it. Also, we sold the $15 puts for 450. Well, that's net 1050. Is Cliffs at 1050? No, it's not. So if Cliffs isn't at 1050, I'm not losing money on this spread. I might look like I'm losing money, but I'm not losing money. So I don't really care, frankly, until Cliffs gets to about 1050, and then I care because then this guy's suddenly on the money, and this guy is out of the money, and then I'm starting to lose. So then I might want to make an adjustment. But what will my adjustment be? Well, let's see. We have the 2016-15 calls. Oops, did not mean to do that. One direction. So the CLF. How far are they? Oh, they have 17. Fantastic. Okay, so you see the 15 calls are now $5, right? These are 15 calls. Now, where can I roll them to? I can roll them to the 12 calls, which are $4. So for $1, I can give myself a $3 additional discount on CLF for $1. Do I want to do that? No, because I still think CLF is worth 15. So I have no reason to lower my basis right now. All right, because now if the CLF jumps back up, I won't make the money. I'll be spending $1 for no reason. But my worst case scenario here, and also I want this premium to burn off, because like I said, Cliffs is at 13 bucks almost, and these guys are telling me it's worth 10. So this premium will burn off, and when I do my roll, I'll get a better price on the roll, and I won't need to put $1 in. I'll probably do an even roll. In fact, these are 268. So in reality, in other words, if these were expiring today, they'd only be $3. They wouldn't be $5. There's $2 of premium in this thing. So I'm certainly not going to roll it with $2 of premium in it. All right, but if I wanted to roll it, I can see right now that I can easily roll it down there for $1. So I can pick up $3 a strike and lower my obligation to buy CLF by $3, which is 20% of the price. I can drop 20% off the price in 1 year by doing this roll, paying $1. So now if we assume that Harry, it's sad that you know who those people are. So now we can look ahead, though, and we say, well, what's going to happen? So if every year I can drop the price of my entry on CLF by 20% for $1, right? That means, now, don't forget I sold the puts originally for, where are they? I sold those 15 puts for $4.50. So all I'm really doing is giving back the $1 that I sold it for, right? But if I give that $1 back 4 times and I lower the price from 20% each time, so I go from 15 to 12 and from 12 to 10 and from 10 to 8 and from 8 to 6, okay? What am I doing? I'm going to still be obligated to buy 1,000 shares of CLF. I would have given back the $4.50 I originally collected, but you know what? Now I'm buying 1,000 shares of CLF for $6 in 2020. All right. If I don't want to buy 1,000 shares of CLF for $6, I should get out now. I can take my loss. Oh, it's not a loss. It's a profit. Well, I take my profit. Wait, is it a loss or a profit? CLF. No, it's a loss. It's about $1,000 loss. So instead of the $15,000 worth of CLF I was planning on taking, I would just take my $1,000 loss right now and quit. But if I want to own CLF for $6, net 6, in 6 more years, then why would I be worried at all? Why would I have the tiniest amount of panic about where it is now? It's nowhere near 6. I want to buy it for 6. I want to buy it. You know what? If it's 6, I want to buy more. I'll buy 2,000 for 6. That's only $12,000. I was going to buy 1,000 for 15. So if it gets down to 6 and I can buy 2,000, I'll do that. Unless something really changes with the business. And as I pointed out yesterday in chat, the funniest thing about CLF is they keep, let's see this, I'll share this on Yahoo Finance, is important. And again, this goes to, none of these people who are writing these articles, none of these people on TV are any smarter than you are. And I don't believe I just wrote Yahoo. That was stupid. All these people with all these opinions, I mean, look, okay, some of you guys are probably young. That's fine. But if you're a person who's had a career, you're like 40, 50 years old, and I will tell you that none of these people are smarter than you, okay? Lloyd Blankfein's not smarter than you. He is differently intelligent than you are, but he's not smarter. His IQ is probably at most 20 points higher than yours. That's not huge. I mean, when you're 100 and somebody else is 120, that's one thing. But when you're 120, 130, and he's 140, that's not a big deal. Okay, he has a different set of skills than you have, but he's not smarter than you. You know things he doesn't know. He knows things you don't know. That's fine. That goes to every single one of these people you see on TV, all these people writing articles. It goes to me as well. I specialize in this, so I get into it, and I know, and I pick up things. I have a lot of experience, but I'm not smarter than you are. Okay, you know as much as anybody about the stocks that you're buying, and if you research them and if you take them seriously, you will know more than almost anybody else about a stock. But the problem is, most of you guys flip from one thing to another thing to another thing. You don't even know about what you're buying, and that makes it all random numbers to you, and you don't understand why it went down or why it went up or what's going on, and that makes it all very, very scary. All right, whereas for me, I understand the things I buy. I don't buy things I don't understand, all right? And if I understand it, then I know there's a certain price I'm willing to pay for it. I know that long term it's going to come back, all right? So as I was saying about Cliff, here's the funny thing about Cliff. Oh, this really pissed me off. This is a new thing. The Street has a computer that writes articles now. So every time something goes up or down, it says why it did this and why it did that. Every single ticker on Yahoo has articles by the Street saying why they did this and that. It's written by a computer. Complete crap. They just pull things out. Weakness seen in Cliffs as it tumbles 8.4% in Zacks, okay? Cliffs, the clock is ticking. So there's all kinds of nasty, nasty articles about Cliffs. But the funniest ones, oh, wait a minute. Okay, sorry about that. So the funniest ones, when you read them, even Zacks, who is generally respected sort of thing, right? They kept talking about, now I'm not seeing it. Jesus Christ. Coal, the producer of iron ore and metallurgical coal. They keep talking about how coal is bad. Now, we know iron is bad. Nobody's building anything. But coal is not what Cliffs makes. They happen to own 3 coal mines, and they own the 3 coal mines to see this company profile here in Thinkorswim. Sometimes you have them, sometimes you don't. They own 3 coal mines, and those coal mines are 4.2% of their revenues, of the value of the company, basically. 4.2%. They own the coal mines to supply them with a steady amount of coal for their iron ore plants. That's what the coal is for. They care less about the price of coal. It's got nothing to do with their business. Yet article after article after article we were pulling up yesterday was talking about Cliffs going down with the coal companies. Oh, coal got downgraded, so Cliffs is in bad shape. It's the stupidest thing in the world. That we know that, so we buy it. We don't panic at a Cliff. I don't care what the Streets robot says. I don't care what Zach says. The guy, I mean, you got to research some of these guys. When you got to, it says Zach's Equity Research, but sometimes you see these authors who write these articles, and they're just kids. They got no clue what's going on. They never worked at a steel place. They never worked at coal mines. They don't know anything about it. They probably never set foot in these places. They're just like junior analysts writing articles. And you know what? For one thing, you get what you pay for. Yeah, that's right, Jim. Because he's saying this computer one. Here, check out the street. It's too funny. I mean, you got to check these out. I mean, they have editors. They all have editors, but you can tell that the format is the same every time. Demand for coal in China may peak, which could hurt coal miners such as Cliffs. See, they're classified as a coal miner, and this guy, Sean Ingram, is a moron and knows nothing about this stock. All right? They stick Kramer's picture on it, which makes it seem official. and they talk about it because it's misclassified. Somewhere there's like a little indexy thing somewhere that misclassifies Cliffs as a coal miner. And therefore, all these people have no idea how this business operates, write about Cliffs as if it's a coal miner, and put down all the little platitudes about coal mining as if, look, investments in coal may be hurt by falling costs. It makes no sense. It has nothing to do with this company whatsoever. This son of a bitch has the balls to charge you for this data and call it a service. This is a con. This is a sham. This is a fraud. I don't know, whatever you want to call it. It's horrifying. He's not embarrassed, so he's got your money. He doesn't care. He certainly doesn't give a crap if you make money or lose money. Look at this. There are a host of signals that Chinese demand for coal is close to peaking, which will cause a seismic shift in the market. Again, coal. The company doesn't sell coal. Yet because they own 3 coal mines, they are classified as a coal miner, and therefore every bad piece of crap that's thrown in on coal miners is thrown in there. And in fact, I bet you if we go to BTU, here, I'm going to copy this. I don't know if it's going to help, but I'm going to copy this. And now we're going to go to BTU. And here, why Peabody Energy is up today. I might not say it because it's up. The coal company, Peabody Energy, the company expects. No, it's not. See, it's because it's an up article. See, when it's up, they have a different article. When it's down, they have a down article. Ah, shoot. Okay, let's take ACI. I just want to find another one that's down so we can look at it. BTU is, whoa. BTU was up because it hit a ridiculously low price, and I called it up yesterday. In fact, I think it was on my main page yesterday. No. ACI. That's better. Ah, nothing from the street there. Oh, well. Anyway, so sometimes you catch them. They like use it's basically cut and paste stuff. They just put it in there. The computer generates these things. It puts in, it's a coal company. Therefore, if it's down, we're going to say this. If it's up, we're going to say this. You know, they have positive and negative things to say about coal. They stick it in there, and there's your article. And that's how they crank out, because on Yahoo, the point is to get the hits. All they care about is they get a hit, and you pay, and you click on the article, you're hitting their advertising. That's the whole purpose of these articles, is to get you to read them. It has nothing to do with informing you. And that's another thing. You've got to wise up, okay? When you're not paying anything, it's not a public service. You know, when you're running around getting free information, there's a purpose to the free information. The purpose is to attract your eyeball and get you to click. It's not to make you money. They don't give a crap whether you make money or not. All they care about is that you read the thing. and you pay for the ad. When you click, their advertiser pays them. That's what it's all about. It has nothing to do. There's nothing there that's meant to inform you, and there's nothing there that's trying to take care of you or help you. It's the point of the article is to get your attention long enough to build the advertiser for you seeing the ads. That's what these are all about. And what happened with Yahoo now is Kramer. I mean, Kramer says, look, he's a smart freaking guy because this is brilliant. Because Seeking Alpha and Motley Fool got thrown off because I complained about it enough where they finally threw them off. I was communicating. I wrote articles about it. I communicated with the Yahoo people. I just kept pointing out, like, these guys are shit. This is bullshit. You're not doing your readers a service. They finally threw them both off the site because of the bullshit writing of those two sites. Now, Kramer steps up, though. He's got that air of legitimacy, and he creates these bot programs to just stuff articles into Yahoo, so he controls the board at Yahoo now. So unfortunately, I unwittingly have made Kramer more powerful, which sucks. But so now he gets to put his crap in constantly because all he has to do every day, whether it's up or down, he's got an article for you. No matter what this thing does, his bots are like writing things and putting them in. His stock of the week, BTU. That's interesting. Oh, I don't want to. Going to start the video. Anyway, so things to look out for. Let's keep it in that category. You can't, you've got to know your own stocks. And when you're buying something, you've got to have your own value, and you've got to see what something's worth. In BTU, for example, boy, this is slow. Anyway, all right, well, it's almost 3 o'clock. In BTU, they're a very strong company. They're very diverse. They've got tons of mines all over the world. They're pulling in $7 billion in revenue in a bad year. Last year, they lost $500,000 there. They made $1 million here. And we know we're in a down cycle for coal. They're on pace here to do $6 billion. It's not very good. They're going to 6 plus. Hopefully about $6.5 billion this year. But look, they got their costs under control. They took a big hit here. That was mostly a loss. They got the cost coming under control. All right, so what's going to happen? So if you hold on long enough, they're going to have a loss carry forward that's going to obliterate their taxes, and they'll make a ton of money. They'll have another $1 billion profit year, and the price will shoot back up, just like it always does. It's a cyclical business. The thing about cyclical business is BTU. The thing about cyclical businesses is they used to be always priced at about a PE of like 5. 10 would be a lot for a cyclical in the old days. Now they price cyclicals at 15, which is a crazy price to pay for a cyclical, because the reason they priced at a PE of 5 is because sometimes they would make a lot of money, but then they would lose a lot of money. And the PEs are based on the assumption that you're not flipping in and out of the stocks constantly. So now people get in when it's good and out when it's bad, and it's crazy, and it makes the stock price go crazy. So meanwhile, this is too little. You can see that here. Look at the spike down. That's a blow-off spike. I really like them down here. So this is way too little. And over time, they're a good, steady investment. Even though coal is out of favor, as I wrote the other day, China is 60-something% coal, their power. Europe, the biggest trend of coal, the biggest reason I called BTU along at 13. So I put my foot down the other day and called for a new play on BTU for long. The tipping point for me, because obviously China's always 60% energy and so on and so forth. There's no change there. The big change I saw was that the G20, their little meeting on energy, is not really going to come up with any concrete reforms in the next few years. So BTU say for a few years. Number 2 is that in the EU, it's costing the power plants. They're losing 17 euros, which is like, what, $25. So they're losing like $20, $25 when they use natural gas to make electricity. But when they use coal, they're making $5. All right? So some way or another, that's going to give, and they're going to go back to using more coal. They were using natural gas, but now the subsidies ran out, and if there's no subsidies, the power plants can't keep losing $20 per megawatt. So they have to produce with a more efficient source, and the only more efficient source they have is coal. Now, If you want to find a side investment that could be good, I would look to like the companies that make whatever it is that scrubs coal, you know, like scrubs the smokestacks and things for the power companies. Those guys are probably finally going to make some money because the power companies are going to say, well, geez, I can't afford to run on natural gas. I need to run on coal, but I got to keep my emissions down. So therefore, I've got to put in whatever technology there is to knock down the natural gas, the CO2 emissions from my coal burning. So that is going to be a good business. I think GE is probably good for that. I'm sure there's other companies, but it's not my thing. I don't know about it. But if you want to look at the trend, that's going to be a trend because they basically prove that the EU can't afford to fund them. They can't afford to pay out of the general funds to keep the subsidies on natural gas burning plants. You can't build solar fast enough, but that'll be the future too, is more solar. And yeah, less natural gas from Russia. Sure, that's putting more pressure on the prices. But even so, unless we really step up LNG exports and things like that, it's just never going to be a good enough way for them to utilize natural gas. It's not local to them. You know, Europe is one of the only places where they don't actually have natural gas. They would have it, except Europe is very crowded. It's very densely populated, and they also have a lot of environmental restrictions, so they can't go tearing up their land to get natural gas. There probably is plenty of natural gas there. They just can't get to it because it's just not feasible. So they get it from Russia, who doesn't care about their environment, right? And they get some from down south from the top of the Middle East, and they can get some natural gas there, but really they're not in a good spot for natural gas. It ends up costing them. They have very few pipeline sources. It's a messy way for them to get their power. So it ends up costing them so much more than coal. Coal, they can get all the coal they want if they want to take the coal. England's got coal up the ass. That's the problem. So there's going to have to be a compromise somewhere, and I don't know what's going to happen exactly, but there'll be more coal use. We're probably at the bottom of coal at this point. And so yesterday made me quote it because of what I saw. All right, that's a good place to leave off. That's our trade of the week then still is BTU, since you can still get it to here. I wish we had seen this. I don't know if that really happened, though. I mean, sometimes these things say they did that, but they don't. Let's see. Oh, and see, none of these guys really panned out. They all kind of fell down. Boy, meanwhile, the market's in bad shape, huh? We'll see where this ride ends. Glad we do have all those DXTs. What is that? Oh my God, it did do that. That's 845. That's pre-market though. Whatever that was, it didn't count. But it probably was trying to flush out stops and things like that. But so I stick with my call the other day when I wrote the article. I think it was yesterday maybe. I wrote a whole thing about why BTU is good, and 13 is a very good price. So I like it here. All right, guys. Thank you once again. We had a lot of fun. It was an excellent session, and we shall do it again next week. All right. Take care, everybody.